Many negative economic indicators have hit the headlines in recent weeks and months, but experts and ordinary citizens alike assume that it is only a matter of time before the U.S. economy reverses course and experiences a significant recovery. The time bomb that no one is looking out for, however, is the imminent collapse of the American currency. When the mighty dollar falls, the devastation will be severe. Its position as a global reserve currency gives the United States significant economic and political leverage, including such benefits as lower borrowing rates from other countries, which positively impacts both the government and the American population. But as the dollar crashes, the United States will experience serious economic pains, and another currency will have to fill the vacuum left in its absence. According to goldmoney.com, the dollar could experience a total failure as early as the end of this year. After all, most of the big-name banks across the world are currently in a worse position than they were even during the Lehman Brothers disaster. If these institutions were to collapse, financial markets would follow. Unfortunately, the Fed has already made its own fortune dependent on the future of the US dollar. One potential solution is that a reset could be implemented, which means that all nations would need to agree upon a new global currency system. The last time this happened was during World War II, when the Allied nations agreed that the US dollar would back their currencies, due largely to the fact that the United States owned the majority of the world's gold supply at the time. Now, in order to maintain control, the U.S. could bring back the greenback, which is different from the Fed's dollar. But this measure would need to be paired with additional policy that stops the inflationary financing defining the current administration's response to the pandemic. In an election year, and a particularly turbulent one at that, this shift is unlikely to come about. It is difficult for people to imagine their national currency falling by the wayside, but historically any fiat currency not backed by gold or silver has failed. It seems to be an inevitability. This typically occurs in two stages: a prolonged period of falling purchasing power, then an abrupt collapse when a currency's users reject it. The current climate of economic distress, as we plummet towards a depression, sets the stage for currency depreciations across the globe. In this video, we're going to address the conditions that has gotten us to this point, assess the risks of a dollar collapse, and tell you how such an event will affect the average American citizen. It all started on Monday, March 23rd. At that time, the US dollar was at the peak of its trade-weighted index, a measurement of the foreign exchange value of the dollar against various foreign currencies. Simultaneously, the prices of gold, silver, and copper spiked after weeks of decline, and oil followed. The S&P 500 also made a comeback the day after, on March the 24th, when it ended a near 30% decline before recovering all of it and then some. These indicators could show that the world assumed economic activity would jump back after lockdowns lifted, allowing economies across the globe to experience positive growth again. On the other hand, the slip in the US dollar's trade-weighted index could be a sign that its purchasing power was going down at a faster and faster pace. Stimulus money pushed out by the Fed keeps stock prices high and investors optimistic, while other important indicators like silver and gold have gone largely ignored. Around March 23rd, the gold-silver ratio peaked at 125 before experiencing a downturn to 98, marking a slight return of value to the resource that has long been viewed as a rather useless industrial metal. In the weeks leading up to that day in late March, the Fed cut its funds rate, the interest rate at which institutions like banks and credit unions lend their reserve balances to other similar institutions, multiple times. On March 15th, they cut them to zero. Meanwhile, the Fed also expanded credit to support individuals and businesses, just another policy designed to prop up households and companies that were struggling as a result of the virus pandemic. These aggressive monetary policies were helping for now, but eventually leave the U.S. economy and its citizens much worse off. Keep in mind that the Fed relies on commercial banks in order to implement its monetary policy. When banks believe that everything will return to normal once the health crisis is under control, they are more likely to agree to increases in lending. However, the losses are getting harder and harder to bear. Businesses and individuals alike are defaulting on their loans in record numbers, and the likelihood of a speedy return to pre-pandemic levels of economic activity shrinks with every passing day. Furthermore, liquidity strains in the banking system are appearing even as the Fed attempts to utilize quantitative easing to diminish the bank's suffering. With quantitative easing, the Fed purchases longer-term securities from the open market as means by which to increase the money supply and encourage increased lending. In eerily similar conditions to those that precipitated the Great Depression, banks now are highly leveraged on their balance sheets. The economy was already declining before the pandemic threw things into a further downward spiral, and now, with the Fed injecting capital wherever and whenever it sees fit, financial assets are becoming ominously overvalued. With liquidity at a minimum, debts will compound and loan risks will skyrocket. The largest risks to commercial banks come from lower-level borrowers, as large corporate borrowers have better chances of being bailed out in emergency situations. We could very well see the widespread failure of global, systemically important banks, G-SIBs, given the shocks of the supply chain disruption across currencies. It would make sense for the Fed to encourage investor caution as overvaluation becomes an increasingly serious issue. But if they walked back their aggressive policy now, it would signal concern and trigger mass consumer panic, causing a catastrophic collapse. Like it or not, the future of the dollar has become anchored to confidence in financial markets or lack thereof. Some experts are like the saying, "In troubled times, money heads for home." Well, in March, foreigners reduced their exposure to the US dollar by $227.9 billion. The same month, the United States recorded a trade deficit of $44.4 billion. Take note of these statistics because one of the defining market factors that has historically preceded the collapse of a fiat currency is the selling off of the currency by foreigners that hold it. As a result, the dollar's purchasing power will suffer. With global trade down because of the pandemic, foreigners will be further motivated to convert dollars back to their home country's currencies, as well as to stop funding the U.S. government through holdings. In the wake, investors and speculators would focus instead on equities. Their shift would be mirrored by foreign investors who would want to decrease their risk and exposure by dumping dollars. Any way you spin it, the desire to sell U.S. dollars will only increase as the crisis goes on. If things were to crumble in this way as the U.S. dollar tumbles into a freefall and politics complicate matters further, questions will turn towards the U.S. government and the Fed. It's bound to come to light that the Fed's policies now are essentially sacrificing the dollar in an attempt to fund the struggling government, to keep a crumbling banking system afloat, and to support the fraying U.S. economy by attempting to provide the liquidity it so desperately needs. The monetary policies they're pushing are far from successful. As the United States plunges towards a presidential election, its citizens had better hope that a future administration has a better handle on the situation. But it is extremely unlikely that even an extreme political shakeup will change the trajectory the country is already on. The next phase comes when Americans realize that, in fact, prices are not rising at grocery stores and auto shops. Instead, the purchasing power of their native currency is going down the drain. Upon this realization, consumers will only drive the value down further, rejecting the paper money in favor of products themselves. Based on past examples, it can take as little as 6 months for such a collapse to unfold. There is even the potential that the dollar's crash could be accelerated. As cryptocurrencies rise in popularity and in use, more individuals may begin to consider the risks and weaknesses of traditional fiat currencies that are not backed by gold or silver. Furthermore, as old standard cash and checks are increasingly swapped out for digital payments, and modern communications technology leads to the rapid spread of information, fiat currencies will seem less and less like the most sensible option. Remember, it still remains possible that the U.S. Treasury pushes a reset, likely using greenbacks, which were last issued in 1971. However, this would also require that the government stop propping up its populations with injections of cash, and this is unlikely to happen. As the virus pandemic rages on, fears of a second wave amidst reopenings intensify. Moreover, replacement currencies often fail unless government financing by monetary expansion is abandoned. Alternatively, the U.S. Treasury still holds more than 8,000 tons of gold. The country could very well reintroduce gold convertibility for the greenbacks, but this leaves the U.S. vulnerable to competition from other global superpowers like China, which could put up a gold convertibility of its own, one with potentially more power. While the exact amount of gold held by China is unknown, some experts estimate that the number is as high as 20,000 tons of gold bullion, and that was back in 2002. There is sufficient evidence to back up such beliefs. For one, China boasts the largest gold mining operation of any country in the world. Estimates pin the amount of gold they've mined since 2010 at around 4,200 tons. Second, gold and silver refining processes are fully under control of the Chinese government, and next to no refined gold kilo bars are allowed to be exported. Third, Chinese citizens were encouraged by the government to get their hands on physical gold back in 2002. That's the year the Shanghai Gold Exchange, or SGE, was established. In the first 8 years of its existence, the SGE transferred an estimated 17,200 tons of gold into public ownership. Fourth, China's allies in the region, particularly other powers like Russia, have been gathering stockpiles of gold and getting rid of US dollars. Finally, China essentially runs physical gold markets. With this data in mind, and given that China seems far more open to the idea of gold holding a monetary role within its society than the US government seems to be, China is in the position of dominating global markets as fiat currencies crumble worldwide. In coming years, we may just see a gold-backed yuan becoming the foreign currency of choice throughout China's sphere of influence. That's Asia, Eastern Europe, the Middle East, and Africa. As we see a seemingly non-stop string of bankruptcies and issues with loans, the banking crisis is almost certainly coming, and it will disrupt any notions of a return to normal economic activity post-pandemic. Even though the Fed is simply throwing money at the problem for now, that strategy can't last much longer. These policies will have the opposite effect, not saving the U.S. economy, but instead crippling its fiat currency, the mighty dollar. In response, maybe we will all return to metallic money and the stability of prices fixed in gold or silver, especially as we see the monumental disappearance of $100 trillion of fiat money across the globe. After what took place on March 23rd, the chances of these events are much higher. So grab your gold, grab your silver, and hunker down.